Okay, good morning, everyone. Thank you for coming in person for my presentation. Today, I'm going to present my work on using computer vision, pattern recognition, and large language models to understand asset pricing anomalies. Visual data is very essential in financial markets. A financial trader may have 8 monitors to monitor the market data, and they want to check the price and volume trends to make decisions. And in finance research, visual data is not yet widely used. However, with the lately developed AI tools, including computer vision, pattern recognition, and large language models, this may allow us to use more visual data to develop deeper insights into asset pricing anomalies and understand the mechanisms why the price is essential. It can help us improve predictions under economic restrictions when the economic restrictions are reasonable. This can help us enhance the data efficiency and inform decisions for investors, regulators, and beyond. I noticed in the literature, there's a debate about why the neighborhood illiquidity indicator is priced. The debate is about whether it is the compensation for illiquidity or mispricing. So neighborhood is a very well-cited indicator. It's directly linked to the concept of liquidity in the financial market and therefore is tied to the market microstructure. But however, its pricing remains in question. So this is an indication that more work is needed to be done for understanding why factors are priced. So now I can use emerging technology like CVPR and large language models to fill this gap and may help provide additional insights about the mechanisms behind factor pricing. So CVPR has been a rapidly growing field, and from the image net, which links to millions of images to objects, and the convolutional neural networks and the recent vision transformer and vision foundation models, it has been gaining traction. And these models it's based on vast data sets and knowledges to extract visual features. So using CVPR, I can extract essential visual features from the price and volume trends in a financial market, and then use these visual features to make inference. For large language models, it's designed to predict the next token in a sequence based on the context. And it has very strong generalization capability. In my study, I used the large language model to predict the visual features of price and volumes given a high quality of academic context. An example is Professor Moreno Hara's market microstructure theory book, which provides a spectrum of cherry-pick theories and models. And under this context, we can predict under each model what the price and volume are going to look like. So, and we can further determine whether reject or not reject a model based on the observed patterns. And my choice of using academic papers instead of news data has some advantages because the high quality academic papers has very high signal to noise ratio and is cherry picked by peers. For news data, it may contain some bias and noises, so which may affect the performance of deep learning. So my contribution to the literature include I use alternative data in asset pricing. I adjust the visual features to understand the mechanisms in asset pricing. So it's parallel to the use of X-rays in healthcare industry for diagnosis of conditions. And I also made an innovation of combining CVPR and LLMs to study asset pricing, which is beyond the traditional statistical models. My work is also related to machine learning for hypothesis generation. My approach can be is scalable and have potential to automating the scientific discovery process in asset pricing, and it's like an autopilot. In this study, I focus on the amplitude indicator. So this is traditionally market liquidity data and help us better understanding market microstructure. So the first step to achieve visual features of a factor, first I need to create well-crafted graphs and of prices and volumes. And asset pricing premium is about is usually defined as the return difference of a high portfolio and low portfolio based on the ranking of the indicator. At this study, I use amplitude to rank the stocks and then pick the top 10% and bottom 10% to form the portfolio. And I check the price before they are selected into the portfolio and the prices after that. So I can have a time series of prices and volumes before they are selected into the portfolio. And I aggregate these trends across stocks and periods so that I can increase the signal to noise ratio. A signal to noise ratio is essential for deep learning because deep learning is sensitive to noises. So by averaging across stocks, I can identify a clear pattern, and this may help the vision model to learn the features better.
Qihong, I'm sorry to interrupt. Are you displaying the slides in the classroom or not? Because from what I see in the classroom screen, it's not displaying. I can see it on Zoom, but just to your back on the screen.
So back on my screen, yeah, it's not, but there's a bigger screen showing my slides, and the audience can see that. Thank you for seeing that. So this is an example of the price and volume trends of the high amplitude portfolio. High amplitude portfolio is traditionally low liquidity. Means the trading volume is low and transaction cost is high. And zero is the time when it's selected into the high amplitude portfolio, and I can check its price and volume trends and adjusting it based on pharma fans 5 factors model. I identify a clear pattern that before it attain assets return at month 0, its price drop rapidly and trade volume also drop, and after month 0, the price start to increase and the volume also resumed to the original level.
What is month 0?
Month 0 is when the stock is selected into the high amplitude portfolio. because when we define Emerald premium is the difference between the return of high MA portfolio and low MA portfolio. So when it's selected into that portfolio, I can check its price before that and after that. I can have the price and volume before and after that. Then I can draw the graph and I average it across stocks and periods. Then I can have a clear pattern. This is very smooth, indicating that is a clear pattern. Having a clear pattern with high signal to noise ratio is good for the vision model to extract visual features. Okay. And this is a the low input portfolio. So it means the trading volume is usually high. And in a regression analysis, it usually have a negative return in the next period. However, when I plot this graph, we see before it attains this negative return, its price goes up rapidly and with volume going up. So I see the full picture by plotting its price and volume trends before and after they are selected into the portfolio. Then I use the vision foundation models of the state-of-art AI tools, which is a hybrid of CNN and VIT. VIT means vision transformer. So they both have advantage. And I extract vision features like price shocks, liquidity issues, and trends from using the vision foundation models. So these features provide insight beyond traditional statistical tests, particularly in understanding anomalies like Emerald illiquidity premium. Then I use large language models to understand these visual features. First, I let the large language models to have a very large knowledge base. They can have the knowledge of market microstructure, asset pricing theories, and evidence. I can let them have this knowledge base and feed them with high quality peer review academic literature. And then under each of these model, as a context, they can predict the next token. The next token is the visual features of prices and volumes. And then I can understand the visual features of a spectrum of related model.
Qihong, sorry, 5 minutes.
Okay. And then we can use a reasoning of large language model to reject or not reject the model. So for the high ML portfolio, the efficient market hypothesis is rejected, and the compensation for illiquidity is not rejected. Market microstructure reasons are not rejected because the visual patterns indicate price reversal and inflation in high illiquidity environments. For low ML portfolio, it's in line with attention-induced trading. So I feed it with a low input paper, which is driven by attention-induced trading, and the volume surges align with attention-driven trading behavior, and it does not reject mispricing. I also feed some not directly related papers as a placebo, and it says they are not related, not available. So, for example, the relativity theory in physics, which may not be directly applicable to financial market, then they say not available. And my method is not disconnected to the traditional method. They are complementary. I can get the results from traditional tests, including farmer members, horse races, double sorting, and feed it in a model. So with these new facts, in addition to visual features, they can make better decisions about accept or not accept the models. So my work combines CVPR and large language models to extract valuable insights from price and volume trends. And my method is complementary to traditional econometrics methods and offers new perspective on asset pricing anomalies. And this methodology is scalable and can be extended to other asset pricing anomalies, and is opens a new research avenues in financial markets. Okay. Thank you for listening to my presentation.
So a couple of comments just on your presentation, right? You stared at your screen almost the whole time and didn't engage your audience. When you're interviewing, if you do that, it doesn't work well,
Okay.
right? So your presentation is to people, okay? So you're gonna have to work on that.
Yeah.
I think, you know, the Hemingway measure, there's been a couple of papers, one of them written by Hemingway, that show that it's priced. There's a lot of papers that show that it's not. So it's kind of a strange topic because not everybody agrees it's priced. And so you're kind of attacking something that most people aren't sure about anyway. So that's something to consider. I mean, part of what is confusing to me is the Hemingway measure is, right, it's the daily price change over volume, right? So it's really the daily price volatility over the daily volume. And it's a little confusing to me exactly what you're looking at, because you, like when you talk about volume goes up when there's more attention, right? That makes sense,
Yeah.
right? And by definition, the Hemingway measure goes down, right? Because it's divided by volume. So I'm not sure what your rule is here. I'm not sure what we do with it, right? I mean, you know, we have the Farmer French 5 model. Then we also have a model that uses a liquidity measure that nobody in microstructure likes, right? But what we're left with at the end is, okay, what do you do with this? Right? I mean, could you put it in a Farmer French model and then show that it's priced, right? Can you make money off of your long short portfolio, right? I mean, I'm not sure what we learned here. And so that's what I think you're gonna have to work on, right? What did I know when I finished this paper that I didn't know before I did? You see what I'm saying?
Yeah.
I mean, in 20 minutes, it's hard to do, right?
Yeah.
And one of the things that I think you're gonna really have to think about is how is this work relating to Brian Keller's work in asset pricing? I mean, he's written like 10 papers using machine learning and asset pricing. He's not doing this visual, the CVPR, but people are using LLMs, right? And so I think you're gonna have to sort of make it clear how, you know, if I were you, I'd be talking about how this work complements Brian Keller's, right?
Yeah.
Because right now, you're using a technique that nobody really has used. And at the end of the day, I still don't know what we know.
Yeah.
So there's work to be done.
Yeah.
Maybe Will has other thoughts.
Yeah, an idea that my work is complementable to in terms of predictability is that if the large language models is with a large knowledge base with academic papers, then they can do a better job in terms of predicting returns than the models without the high quality academic input.
Yeah,
I think I can show that.
but that's what I'm not getting, right? What I'm not getting is, here is what I can do a better job. Here are my 4 things.
Yeah.
You just say, okay, yep, nope, okay, not really. That's not a better job, right?
Okay.
You need to be real clear, here's 4 things that, the fact that you can't reject inventory models, nobody rejects. Right, the fact that you rejected the efficient markets hypothesis, no microstructure guy believes in the efficient markets hypothesis, right?
Yeah.
So that's not, you need to be more precise because you're writing a paper about asset pricing, right?
Yeah.
And you gotta relate this paper to asset prices, and that's, I think, what has to happen. But maybe Will has a different take.
Right.
Yeah, if I may just add to what Maureen has said, I completely agree. I think there are a couple of dimensions you need to work more on. One is presentation. That's something we can work on. And just in terms of the contribution of the paper, I think this is very creative, innovative, conceptually. But claiming that conceptual contribution alone is not sufficient, right? You have to show this concept actually works. And whether Amihu measure is the best place, the best example to show, or maybe you can add a few other examples, right? In this case, at least it's not rejecting things that are sensible based on literature. Maybe in other examples, it really helped discriminate against theories, across a broad spectrum of proposed theories. That would be more convincing. And also, just in terms of describing the methodology, I think given the time constraint, I understand you can't delve into the details, but still, you got to explain, why this is working well. Not so much about the large language model or the image processing part, but more on, what do we expect to pick up that cannot be picked up from, more traditional analysis on numerical data that people have been working on. I think there's upside and promise, but the kind of the details, the devil is in the details. So that's something you need to work on.
Qihong, another thing you want to think about, you're using these visual displays of prices and quantities. That reminds me very much of technical analysis, right?
Yeah.
The technical analysis guys, they look for candlesticks and the data,
Right.
they look for this. Maybe what your work is saying is that in an era of AI, technical analysis can come back. Right? Maybe that's a
Yeah.
direction you could take this.
Yeah.
I mean, most people kind of dismissed technical analysis, but that was before we had all this data.
Right.
I mean, maybe there are these patterns in the data that you can see that can help predict where prices are going, which is what technical analysis always did. So that's probably not something you thought about. Maybe that's something that could work its way into your work.
Yeah, and my work is not focused on statistical arbitrage based on image. I use the image to understand the underlying economic theory. Maybe I can show by understanding the underlying mechanism, we can make predictions more efficiently because we know the proper economic decisions. And
It's
then we
tricky
make
though in finance, right? If you're saying, well, now you can build better models, someone will say, I don't care.
Right.
Right? I wanna price assets. Show me you can price assets in a way that's better. And how do we measure better? Well, look, I
Yeah.
can explain them better and you can make money, right? You form these long, short portfolios, right? And that's what you're doing, aren't you? You're creating a factor in
Yeah.
some sense, aren't you?
Yes, I
And
do.
what you're arguing is that factor is price, and you can make money doing this. And you understand more how to build better models, right? Now, I'm just saying that, just saying, I got this, I mean, I think Will's point is saying, I've done something nobody's done, isn't this cool? It's fine, but it won't, you gotta make that next step. Why is it cool? Because this model beats the Fama French fine. Or
Yes.
this model does this, right?
Yeah.
You gotta get to the finish line. You're in the middle of the race. That would be the way I would look at it.
Right. Thank you.
I don't think.
So as a complete outsider, the way I understand financial markets is we need to quantify things, right? And the large language models are specifically designed to get information that otherwise would not be quantifiable into some indices, numbers, and basically be plugged into FOMA 5 or any factoring model. So now come you and you say something very different. You say, I'm going to plot the data, which is already quantitative, right?
Yeah.
And I'm going to run it through, you can call it whatever it is, but it's a very complicated filter that allows you to transform visual data back into an index, right? If it were to work, if it were to do what Maureen wants the model to do, it has to go, right? So you have data, which is quantitative, you visualize, then you run a filter on it, you come up with a quantitative measure of whatever that might be, and then you're going to use it to make it useful. So the challenge here is to inform the reader as to why that filter that you are creating, that CDIT or the visual filter that you are creating, that operates already on a quantitative data, is going to do any better than direct analysis of the underlying data that you have plotted. If you can overcome that challenge, I think you are going to make money. If you are not, then this is where the economics stops and the finance market microstructures should speak, because that's my limits. About that, I would not know how to do it.
No, I think you put it well. I do. I think that was exactly some of the issues you need to think about.
Okay, thank you for your comments.